We're going to talk about renting versus owning today.
And current rates.
And current rates. Well, you're not going to like what I have to say about current rates, but it is what it is, ladies.
We kind of thought that. Hello, this is our Monday Market Update with John Murphy. You wanted to introduce him? Oh, I'm Rozella. And I'm Steffani. We were flipping it around the day and introducing John first, since he's normally so kind and introduces us.
Yep, wanted to have some fun today.
Well, that's pretty fun. I like it. Not only you're color coordinated, but you guys were in synchrony with that. I mean, in harmony. It was great.
We don't practice that.
It was a great kind of day for our area.
Okay. Well, let's brighten it up, shall we?
Please.
Please tell us about the rates, John. Is that going to brighten up our day?
I don't think that's going to make you really happy, Rozella, this morning. I'm sorry. However, the Fed is meeting today, and they're going to release some information to this afternoon, and we're optimistic. But I'll tell you, the data has not been supporting our optimism. The rates are kind of hanging in there high. Matter of fact, they're higher than what they were probably a month and a half ago. They just kind of drifted back up. And I don't know that I could look at the data and support it very well, because there's this tug and pull, as you know. The economy, if you talk to the average consumer, doesn't really feel really strong, does it? Right? And talk about inflation, look at the gas prices and stuff like that, right? So there is that. And unemployment is, by the data, it's really not bad, but you talk to people on the street and it's not so good. So there's this confusion in the data. And maybe that's what's driving rates, but rates are higher than what we would have liked. The predictions were, we would have thought about now that they would probably have been in maybe the low sixes, mid sixes, and we're in the high sixes, low sevens for 30-year fixed rates. Now, keep in mind, that's conventional. Government rates, FHA loans, VA loans, USDA loans, are all of those. The rates are lower with those programs. However, you have mortgage insurance to contend with those programs, so it kind of makes up the difference. So have I brightened you up, ladies?
Well, I don't think it's a brighten up, but we really appreciate you shooting us straight on it.
Right.
Yeah.
So you're seeing right now high sixes, low sevens is what you said.
Yep.
Okay. Well,
kind of where it's at.
Leads us to the next topic at hand, because in a market like this, where a lot of people kind of got accustomed to those lower rates, and we're really after that,
got spoiled.
We keep trying to tell people, don't wait, don't hold off, don't think that they're going to go to that again, because, well, as we're showing and seeing, it's not really realistic, and it's, you don't know what it's going to do. So we have the question that always comes to play of, should we buy, should we rent, what should we do?
Such a good question, isn't it? I'm going to show my screen and we're going to answer that question, okay?
I like it.
This is a presentation. This is kind of the summary of a presentation that we use with our clients and agents to show them the numbers of renting versus owning. I kind of tailored this for what the data you told me, ladies, about the rental payments over in Deer Park, Spokane area. So the left-hand column, can you see that? It says rent and then conventional in the next column.
We can see what you read to us.
Okay, fair enough. The left-hand column is rent, and the total payment for rent that we're using in this particular case is $2,890. That came from $2,850 for rent, and then I threw in $40 for rental insurance. Most people should have that. Some people don't. I get it. But that's the total cost of renting in this example. Does that kind of feel right for your area?
Would you say $2,850?
$2,850.
Yeah.
Yeah, especially if you're going to be renting like a 3-bedroom, 2-bathroom, or a 4-bedroom, 2-bathroom home.
Yep. And that's what those numbers are based off of, is like a rough number for a 3-bed, 2-bath home.
Mm-hmm.
That's not going to be any smaller thing. So,
okay.
But yeah, you're right on point.
Okay, so that's a couple is what I'm assuming, and I'm assuming they both make maybe $49,000, $50,000 a year-ish. So together they're $100,000 in income, which determines the tax benefits. There's a standard deduction that you're familiar with, and if they make that much money as a couple, deduction is $29,200. So they can apply the standard deduction, and right below the total payment, I don't know if you can see my mouse here. Now, I know what I can do. Boom, right there is the tax benefit. So they get a tax benefit because of the standard deduction. And their total rent payment is that one right there. As opposed to, we're comparing this with a conventional loan with 5% down and the wonderful interest rate in conventional. I snuck in under 7%, 6.99% conventional loan, 5% down. That has mortgage insurance and it has taxes and insurance. I could show you those numbers, but in the interest of time, this is just the total payment down here at the bottom, $3,455. So it's $3,455, but if they itemize, given their income and the interest expense, the tax benefit is a little greater if you itemize on your taxes, given that scenario. And that's what the people should always do, is compare the tax benefit itemizing versus the standard deduction. And lots of times, especially if you're purchasing like a $300,000 home, and especially if rates are lower, the standard deduction is just as good anyway, and you don't itemize. You with me?
Yep.
Okay.
What's
So let's
the purchase
compare.
payment that you came up with?
I didn't quite hear that. What was that?
What was the purchase price that you used
The
for that?
purchase price is $450,000.
Okay, so
Which is the average for the 3-bed, 2-bath, same size as the rental that you compared it to.
and for reference, for someone who's listening along, if you were to be looking at a home in that 450,000,
15.
415 or 450?
450, 450.
Yeah,
Yeah, okay,
$450,000 price point with that 5% down, what you would need to be factoring in is that down payment amount is going to be sitting around that 22 to 23,000 plus some closing costs, unless you have a great agent like one of us that help you negotiate that.
Yep, absolutely. And the cash to close is actually shown down here. We're including closing costs. So this is one number that Steffani and Rozella can really help you on, because this loan costs about 1/2 of 1 point today for that rate, smidgen over that actually. And with that particular loan program, we will allow the seller to contribute up to 3% of that purchase price, which is over $13,000 to your closing costs. So the cash to close in this example for the conventional is $32,800. That's a lot of money, right? And they may not have that. That drops a lot if you can have the seller contribute and pay your closing costs for you. So that number includes the down payment and closing costs, is what I'm saying. We compare that with an FHA loan, same exact purchase price there. The rate is lower with FHA, as I mentioned, 6.625%. Notice the payment's a little higher down here. It's $3,500 instead of $3,400 and some. That's because the mortgage insurance with FHA is a little bit more than the mortgage insurance with conventional. And guys, this is a very specific situation, and your situation could be radically different because the mortgage insurance cost is very dependent on credit score. So if you have a high credit score, typically conventional is going to have a lower mortgage insurance premium than FHA. FHA doesn't care what your score is. It's 0.55% if you put 10% or less down, less than 10% down, on 0.5% if you put more. So it's consistent all the way through. And it lasts for the life of the loan, which means you're going to refinance eventually to get rid of it. This may be a little more data than you need, but my point here is conventional can be more expensive with the lower credit score, and FHA can be really good if you have a 660 credit score. All right. Cash to close is down here, 26,000, so it's a little bit less. That's because it's 3.5% down, and this cost to this rate is about the same, but it's 3.5% down versus 5% down. So let's look over here on the right-hand side. What this shows is net monthly payments, and the net monthly payment with rent, given that the total payment is $2,890, if we take into account the tax benefit with the standard deduction, they get to deduct portion, their net payment is really only $23.54. I don't know if you can read that. That's that left-hand one right there. As opposed to conventional is $24.97, a little bit more, like $150 more. And FHA is $25.30, really close to conventional. So the net cost on a monthly basis of buying this home is greater than renting the home. But that's just a snapshot, right? Let's take a little bit better look here, a little deeper look. This over here shows you a 60-month look on your net worth, or actually in this case, I'm going to say it's the rental paid versus the principal paid. The reason we look at it that way is the rent you pay out of $183,972 over 5 years is a big number, and it's gone. Okay, you just basically paid your landlord's mortgage for them for a 5-year period. This $25,000 here for the conventional and $27,000 for FHA represents the principal amount paid down. So that's kind of a savings account for you that you are paying down and getting equity in the home. So the point of that one is you're paying a lot of money out for rent and it's going away. You are paying the principal down, and that's considered lost money from this program's perspective. I would argue that with it, but it's the way the program shows it. What's really relevant, I think, is your net worth. And that's what this particular one on the bottom right here shows you. The net worth that you're going to increase your net worth given renting a home is zero. You're not getting any equity in any particular real estate or anything like that. This assumption here assumes a 4% appreciation rate with real estate. And it also assumes that you're going to be continuing paying on the same loan for 15 years. And that number up above, that principal reduction, you're going to be doing that over that 15 years. And so all of that contributes to your net worth calculation. So in the conventional loan, you now have a net worth, which is $554,000. In the FHA world, it's $548,000. They're pretty close over a 15-year period. And as you know, ladies, one of our big mantras here is to show people how to increase and protect their wealth with real estate. That's our focus, of course. We work with financial partners that their focus is other things. We're kind of real estate focused and debt focused, showing people how to strategically increase their wealth. So in a nutshell, you need more money to get into a house to buy it than to rent it. So you got to figure that part out. If you can do that, even with these high rates over time, if you're interested in net worth in particular, it starts picking up. And I'm going to show you one more way we look at this. Let's see. I think it's right here.
For a breath of fresh air for those of you who are like, oh, this is really like a lot to take in.
We're looking at year 9. This is another program, and I have the same information in here, a $450,000 home. This one is using the 5% down with the 30-year fixed rate. This rate here is 7% is what we're using. And this is kind of an easier to see graphic. Notice this is a 9906 area code. So that is basically Deer Park area in Spokane County.
Mm-hmm.
And this kind of breaks it down a little differently, and some people like this. So what that shows you is the net gain by buying a home versus renting. And you can see that you're $25,000 behind in the first year if you buy the home compared to renting the home, and $11,800 down. And it gets back to a little above zero in the third year. So and then you start making progress, which means you start picking up gain in your net worth after on the third year and above. So if you were going to hold on to this home for anything less than 3-4 years, it would certainly not make sense to buy a home. It's too expensive with the closing costs. Now that can really get mitigated by a few things, right? One is we have zero down loans or really, really low down payment loans. And secondly is when Rozella and Steffani negotiate a seller to pay your closing costs and you get rid of 3% of closing costs, that really impacts that number. If you can get into a home, in other words, like some of our VA buyers get into homes with literally nothing out of their pocket. With a VA loan in the mid-6s, they start making money on that property in year 2, at least, maybe even year 1, depending on where they're at and the appreciation and all of that. So there's different factors that go into this, okay? You can see the appreciation gain is $236,000 over a 9-year period there. The amortization gain, that's what you paid down the loan, is over 9 years. You paid down the loan by almost $50,000. You have total tax benefits. There's the $29,200 tax bracket. That's the 22% tax bracket for people that are making over, a couple making over 100 and some thousand a year. So you get the tax benefit of that. And then if you're going to sell, the estimated cost of the selling here is 6%. You take that away from that. The point is You're building up equity, you are gaining in wealth. When you sell, you're going to have to pay some costs and take away from that, but it still makes sense in the long run.
Absolutely.
Okay.
All right. We're getting an oxygen mask going.
I'm telling you, there's a lot of data there. I get it, but you asked the question and I wanted to answer it for you. So there you go.
You did good on answering it. The one thing I want to say is for anybody who's listening that they're thinking like, well, I don't know what I'm going to be doing in a year, 2, 3, because like sometimes that's even hard for people to see out even that far, honestly. But the one thing I want to point out is some key factors here. For someone who is on the fence about buying versus the renting, yes, as we've said, that's a little bit more money out of pocket. So do whatever you have to do due diligence wise to save up for that down payment, or start looking for the different programs that are out there that offer some sort of a down payment assistance if you need it. Some people are already great about their saving and they have it ready to go. They just have been holding off because again of those interest rates. So for those people that are holding off, this is more so the message to them that I would like to say. Oftentimes you will stay in a position of where you're at because you're waiting. And when you're waiting, the only thing that happens is you're now taking just more of your money and you're expending it towards something like we just were shown proof. It's not going anywhere. The other thing that you have to consider is, and especially in this area, I don't think we're alone in this, but you have consistently seen rates of your rental go up exponentially as well. So you're figuring that that's going to maybe sustain you for years. I'm going to say, I don't think so. A landlord's probably not going to keep your same rent every single year. Taxes are going up, insurance is going up. So your payment is likely going to be going up. They're not going to eat the cost, you are. So if you're on the fence, this is why it's important to sometimes just pull that trigger. We know it's super uncomfortable to do, but when you do it, you're now putting yourself into a wealth building position. And I'd almost say, I know that your data says that if you're going to only be there for a year or 2, it's probably more expensive. I'm going to disagree with that.
However,
I'm challenging the data. Well, let me add to what you're okay. Rozella, you first, and then I'll add to what Stephanie's saying.
I was just going to keep on going with that house. That you did want to do something with it in 3 years. You almost are more than likely to have equity built up in the home at that point in those 3 years, even if that's your plan. And if you wanted to use it for an investment property and then do a rental, then at that point you have so many options. Whereas if your rental was just up, well, that's the end of the road, you know? So buying the house, you have so many options even then at that 3 mark when you're like ready to move on. So timeline isn't necessarily, I don't think, a hindrance either for a lot of people.
I wouldn't, and this is why I would challenge that data, because again, in that 1 or 2, 3 year mark, the only thing that's going to really force you to sell in those 3 years is some sort of massive life circumstance that's going to force you to sell. But even then, I would also say there's so many other options that are available aside from just having to sell. I'm exploring that myself. Others, like she has some clients that she's talking to right now that a job is taking them to another state where they only purchased a year ago. They already have equity. A fun little memory that popped up on one of my social medias. Only once in my career has this ever happened. I had someone relocate here. I'm not going to say the name of the state that they came from, but they came up to Washington, purchased the home, closed on it. She's giggling because she remembers this one. 2.5, 3 weeks later, I'm on vacation because I, pay attention to my calendar. I was closed. We're good to go. She calls me and says, I hate it here. I'm moving back. And I said, oh boy, I've never had that one happen before. She still walked away after paying all of her excise tax, realtor fees, everything. She still walked away with almost $20,000.
Wow. Wow.
So, in my personal experience, do not let the time frame of how long you think you're going to be in that home be a dictatorship on how or when you pull that trigger to actually purchase. Because as we know, oftentimes you sit longer than what you intend to, more often than not. And if you're one of the crazy ones out there that just happens to hate it and you want to sell, okay, then great. You're probably still not going to end up that bad as you would if you were just throwing your money towards the landlord, like you said.
Okay, I'm going to add to that too, because I tend to agree with you, ladies. I just did some math here. Okay, so let's say you're paying $2,850 a month for rent for the first year. You just paid $34,000 in rent. So that's money that you could have been saving that went away to the rent. Now you got to live someplace. And so there are options there. But the other thing is that this home that you're wanting to buy is appreciating at least 4% through good times and bad times. And actually in that area, I'm going to anticipate even more. But that $450,000 home, let's say it appreciates at 4% per year, that's $18,000 the first year that you were now trying to catch up on. And I say this because I have people going, I'm going to save up for that 20% down payment. And we do the math together and say, you're just going to be chasing that house because 450,000 is now 468,000. And that's now going to be for another 20, probably 480 some thousand in 2 years and so on. So the sooner you can get into real estate, if that's what you want. Now, there are reasons not to buy houses. And you may not want to be a homeowner. There's a lot of maintenance involved and there's all that kind of stuff. And you got to be aware of that. But if you're transient, if you want to move every year, if you don't want to take care of a house, you're not the right person to buy a house. If you want to build wealth and you want to stay stable and you got a family, there are great reasons to buy a house. And as Steffani and Rozella, and I'm suggesting, don't wait too long because it just gets more expensive over time.
I was just did a quick calculation. One of the homes that she was talking about, I had looked at that bought just over a year ago. They had a 15% increase in their value within that 1 year period.
Yep.
So that was more than enough. And it's an FHA loan. So I'm assuming, they had down payment assistance and stuff. So yeah, they're making out like bandits.
Yep. It is by far the biggest wealth creator for the average American in the United States is real estate. And as you were saying, renting out that home, Rozella, it makes really, really good sense. If you want a really good tax break, get a couple of rental properties. So if you're making $200,000 a year as a couple and you're going, oh my goodness, these taxes we're paying, talk to your tax advisor and look at the possibility of having one rental property and what that will help you with. These things are good.
And we're good at finding rental properties for our investors as well. Cash flow is
they are.
Thanks for all of that information. It's super helpful.
The fire hose approach that you just listened to, guys, I really get that. If it's your situation, we're going to build that analysis together and take some time, and I'll show you the numbers that go into it and all of that. It's going to make much more sense, and you have a little time to assimilate it and kind of digest it so that it makes more sense to you when we talk together about your situation. Thanks, ladies.
Thanks, John. Have a good day.
You too. Bye-bye.